$300 billion. That's how much market value vanished from the software sector in just 3 days this February. Welcome to Money Moves Daily. Traders have a name for what's happening, the SaaSpocalypse. Today we're cutting through the panic to find out if this is a real threat or your next opportunity. Here's what nobody's talking about. Some of the best buying opportunities in market history came when an entire sector got crushed on a narrative, not fundamentals. The question isn't whether AI disrupts software, it's whether the market has already priced in 10 years of disruption in 10 weeks. Let's find out. Because if history teaches us anything, the time to get interested in a sector is precisely when everyone else wants out. Let's rewind to January 2026. Anthropic releases Claude Cowork plugins, AI agents that can perform tasks traditionally done through software subscriptions. Data entry, customer support workflows, basic analytics. Suddenly an AI could handle what companies pay thousands of software licenses for. The market noticed. The fear isn't that AI replaces software entirely, it's subtler than that. The concern is that AI reduces the number of seats companies need to license. Think about it. If one AI-augmented worker can do the job of 3, that's 2 fewer Salesforce licenses, 2 fewer Adobe seats, 2 fewer ServiceNow subscriptions. The per-user pricing model made SaaS companies incredibly profitable. Recurring revenue, predictable growth, high margins. But that same model becomes a vulnerability. Between February 3rd and 5th, 2026, approximately $300 billion in market value evaporated from the software sector. Salesforce shares fell 32.7% in 2026 through late February and 42.1% over the preceding 12 months. Adobe, Salesforce, and ServiceNow have all seen shares slide about 25 to 30% year-to-date. These aren't small caps, these are industry titans. The crisis traces directly to Anthropic's release of Claude Cowork plugins in January 2026, the catalyst that sparked disruption fears across the entire sector. But here's where it gets interesting. NVIDIA CEO Jensen Huang called the theory that AI will replace software his exact words illogical. Huang argues that AI enhances software rather than replacing it. More AI means more software infrastructure, more data processing, more enterprise tools, not fewer. His logic, enterprise software isn't just about performing tasks. It's about storing data, maintaining compliance, integrating systems, and creating audit trails AI can't replicate. Mission-critical enterprise providers like Oracle and ServiceNow may coexist with AI due to entrenched customer workflows in deep data integration. This is the key distinction. Not all software is equally vulnerable. There's a spectrum from commodity tools that AI easily replicates to deeply embedded enterprise systems. Some analysts argue software stocks had run ahead of fundamentals. Many traded at 20 to 40 times revenue. AI disruption fears just exposed unsustainable multiples. In other words, the stocks were overpriced anyway. AI just became the convenient excuse for a correction that was coming regardless. The investment community is sharply divided. Bears see AI cannibalizing SaaS by automating workflows and reducing licensed headcount for good. Bulls counter that enterprise software is deeply entrenched. Switching costs are enormous. Data moats are real. AI can't easily overcome decades of integration. There's also the timing debate. Even if AI disruption is real, enterprise adoption takes years. Companies don't rip out their CRM systems overnight. As one industry analyst put it, it's not that AI replaces the software, it's that AI reduces the headcount that uses the software. That's the bear case distilled. Fewer workers means fewer licenses. The SaaS model depends on seat growth, and AI threatens that growth engine directly. But the bull case is equally compelling. AI needs infrastructure, it needs data pipelines, it needs security, compliance, and governance, exactly what enterprise software provides. The companies building AI, Anthropic, OpenAI, Google, they're some of the largest enterprise software customers themselves. They need Salesforce too. The software industry is worth over $200 billion annually. Disruption fears assume AI captures most of this market, a thesis that remains unproven. History offers perspective here. Every major technological shift triggered sector-wide sell-offs. Internet would kill retail. Cloud would kill servers. The thesis was always oversimplified. Amazon didn't kill retail, it transformed it, and traditional retailers who adapted Target, Walmart, Best Buy, they're still here, often stronger than before. The cloud didn't kill servers, it shifted where they lived. Data center REITs became some of the best performing assets of the 2010s. Disruption creates as much as it destroys. Analysts note that past sector sell-offs driven by narrative shifts rather than fundamental deterioration have historically created buying opportunities. The key word there is historically. Past performance doesn't guarantee future results, but patterns exist for those willing to study them. So what's the play here? First, distinguish between commodity SaaS and mission-critical enterprise software. They're not the same investment thesis. Commodity tools, simple project management, basic analytics, standalone utilities, these face real AI substitution risk. They're features, not platforms. Mission-critical systems, healthcare records, financial compliance, manufacturing execution, these have regulatory moats and integration depth AI can't easily replicate. If you're considering buying the dip, focus on companies with proprietary data assets. Customer data collected over decades isn't something AI can conjure from nothing. Look at customer retention rates. Companies with 95% plus retention have proven switching costs. Their customers can't leave easily, even if they wanted to. Watch integration depth. Software embedded in core business workflows, ERP systems, supply chain platforms, financial controls takes years to replace, not months. One practical framework: monitor upcoming earnings calls for actual AI impact on renewal rates and seat counts. The data will reveal whether fears are justified. Consider a barbell approach. Maintain some software exposure for a potential rebound while hedging with AI infrastructure plays, semiconductors, cloud providers, data centers. NVIDIA's Jensen Huang isn't just talking theory. His company supplies the chips that power AI, and he's seeing enterprise software purchases increase, not decrease. The logic follows: AI agents need software to work with. They pull from CRM databases, push to project management systems, log to compliance platforms. They're users, not replacers. This is the counterintuitive case. AI might actually increase software usage by making it more accessible. Workers who never touched enterprise tools can now interface through natural language. The smart move isn't to act on one data point. It's to know which data points deserve your attention, and right now the fundamental operating metrics matter more than the headlines. The $200 billion plus enterprise software industry wasn't built on trends. It was built on solving real business problems that AI hasn't solved yet. Accounts payable, inventory management, regulatory reporting, these aren't glamorous. They're also not optional. Every company needs them, regardless of AI capabilities. For individual investors, remember this is not financial advice, but the framework of separating narrative panic from fundamental deterioration applies to any sector sell-off. The disciplined investor asks, what do the actual numbers show? Are revenues declining? Are customers leaving? Or is this a sentiment shift with stable fundamentals? In the SaaSpocalypse, the numbers so far suggest sentiment-driven decline. Enterprise software companies are still reporting growth, just not the hyper-growth that justified premium valuations. If this content resonates with you, consider subscribing. We break down market narratives like this regularly, separating hype from opportunity every week. For the contrarian-minded, historically, the best time to build positions in quality assets is when fear dominates and prices disconnect from fundamentals. But this crucial contrarian doesn't mean reckless. It means having a thesis based on analysis, not just buying because something's cheaper than before. The SaaSpocalypse narrative may have overcorrected, or it may be early innings of a genuine structural shift. The honest answer is, we don't know yet. What we do know, $300 billion evaporated in 3 days on a theory, not on earnings. That's a lot of assumption baked into price action. Enterprise software isn't going anywhere this quarter. The question is whether AI changes the growth trajectory over 3 to 5 years, a timeline the market may be front-running aggressively. the prudent path, stay invested but diversified. If the disruption thesis proves correct, your AI infrastructure exposure captures upside. If overblown, software rebounds. This is the market's way of pricing uncertainty. Sometimes it overcorrects. Sometimes the crowd is right. The discipline is having a framework to evaluate which scenario you're in. Here's the bottom line. $300 billion of fear has been priced into software stocks. Whether that fear proves justified is still an open question. What's certain, the companies with real competitive moats, proprietary data, and deep customer integration will survive any disruption. History shows this pattern repeatedly. The SaaSpocalypse might be a buying opportunity in disguise, or the market might be smarter than we think. Your job is to have a thesis, watch the data, and stay disciplined. This is Money Moves Daily, the signal in the noise. We'll see you tomorrow.